Good afternoon, everybody. Um, I'm excited. Today we're talking about different gifts to children, to family, to charities, what's allowed, what's not allowed, when is it taxable, how can we efficiently give that to charitable organizations, our churches. We have a lot of clients who are charitably inclined, and we love working with people that have a heart for ministry or organizations that are near and dear to their heart. And I'm pretty sure we're aligned with 100% of our clients in that none of us thinks the IRS is doing a really good job managing the asset that they have control over. So one of our goals for every single client that we work with is to help, specific to your situation, just minimize your lifetime tax bill. And maybe that's this year, maybe that's 5 years from now, maybe that's when you retire, maybe, there's lots of different elements and layers to that. But I'm excited to dive in today to kind of what we have this presentation. Well, again, we'll try to keep it 30 minutes or less. And as always, feel free to, if you have questions, throw them in the chat box. We'll try to get to as many questions as we have time for. And we'll dive in. So,
Yeah. And as I pull the presentation up here, if you see the top of your screen, you'll see chat and Q&A. Either of those work to answer questions. It's funny, Brian and I have spoken with a couple of clients since scheduled this, and I think a lot of folks thought gifts mean one thing if you ask one person, and gifts mean something if you ask another. So today's going to be pretty comprehensive. We're going to include, as you can see, as I pull up here, the first is going to start with gifts to children, family, and friends. Brian, please confirm that you can see this.
Yes, sir. Looks good.
Perfect. So we're going to start with that, and then we'll venture into gifts to charities and churches and organizations that you care about. So without further ado, Brian's going to get started here as we jump into the first slide.
So every person is allowed to give money to whoever they want within reason. Once you hit certain thresholds, then there's rules around that. There's rules in how much we can pass on and things like that. So these limits, the annual gift limit, and this is if I was to give Jordan money, or if I was to give a random person on the street money, or anybody of my choosing, I could give anybody funds, and I could give them up to $19,000 per year. And me and my wife, we could both do that. So let's say we had one of my daughters, and I'll fast forward because my oldest she's 13 right now, but let's say she's 23 and married, and they're looking to buy their first house, or, I'm just making up a scenario. But in that scenario, my wife and I, we could gift her $38,000. We could also gift her potential husband $38,000. We could do that this year, and we could also do it next year. So it can start to add up pretty quick. And that's $19,000 per person per year. And you can give that to as many people as you want. I can give it to, I have 3 daughters. So if I wanted to give 19,000, or if my wife and I jointly wanted to give 38,000 to all 3 girls, every year, if we had the means and the ability to do that, we could. The issue lies when you give more than that, which you also can do that. So if I wanted to give $100,000, we could do that. When you exceed the $19,000 per person per year limit, you have to file a gift tax return. And that's not a taxable gift. A lot of people think that is a taxable gift. It's not a taxable gift, but the IRS wants to start keeping track of that gift. Currently, every individual person has, you can see on the right side of this slide, kind of our lifetime gift limits, and we can give almost $14 million each, or almost $28 million as a couple. So, if my wife and I were growing our assets over time, and let's say our estate is a $30 million estate, that'd be great, good problem to have. And if we just didn't do any estate planning and we gave everything to our girls, well, almost 28 million of it would pass estate tax free. In that example, a little over 2 million, or the difference there, that would be subject to estate taxes. And you hear a lot sometimes about estate tax, and it's 40% plus. They're very high. IRS loves estate tax, and nobody else should love estate tax. Some of these have changed, but so in a scenario where your annual gift limit, is again 19,000. Let's say I gave 25,000. I exceed the 19,000 by $6,000 in that example. What it starts to do is it starts to chip away at my 13.99 million lifetime exemption amount. So if I exceeded it by $6,000 or $60,000 or $600,000, you can exceed it. You just have to notify the IRS. That's that gift tax form that you have to file. And then it starts to reduce that 13.99 million. So, if I gave $1,019,000, well, my 13.99 becomes 12.99. So I hope that's clear. Let me know if you have questions on that. So that's kind of how the lifetime gift limits work. I kind of already went over that. We move to the next slide.
Yeah, so then when we move into the one big beautiful bill, which I'm sure many of you have heard of already, this is essentially just the most recent tax bill that President Trump actually signed into effect on July 4th. Most of it doesn't actually go into effect until January 1st of 2026. But essentially what the one big beautiful bill did was a lot. I know some of you have probably seen a lot of the details of it, but regarding what Brian was just covering, really it just extends that permanently, and it's also going to index it for inflation. So one issue that we were concerned about, and especially as state attorneys were concerned about, was that 13.99 million was set to go down to about half of that, roughly even 5 or 6 is what some were expecting. So that would have brought a lot bigger issue, right? Many more of you and our clients would have been impacted by this. But as you can see here, they're extending already in 2026 up to 15 million per individual, $30 million per couple. And like I said, it's going to be permanent and indexed for inflation. Nothing in particular was mentioned in that bill about the annual the annual amount that Brian mentioned, but it's assumed to be somewhere around 20,000. So that's what the one big beautiful bill did. Plenty more that we could cover there, but to keep it on track for this specific topic today, and that we can get you out of here in under 30 minutes, as Brian mentioned, we're going to move forward now to gifts and donations to charity. These do work a little bit different, and we're going to start by explaining the standard versus the itemized deduction. So Brian, take it away.
Yeah, so some of you may know, some of you may not. I get really excited talking about this stuff. I was telling my wife about this, and she's just like, "You guys are such nerds," but it's so fun. It's just we can add a lot of value in these areas, and we try to work to the best of our ability with really good CPA and tax planning partners. And a lot of you've probably heard me say this. It is becoming harder and harder to find tax advisors and CPAs that that they'll look specifically at your situation and offer just insightful, thoughtful guidance on, hey, did you know you could write this off, or you can deduct that, or more and more we're seeing just CPAs. What they're doing is they're just they're filing a return, and that's not bad. We need help sometimes filing returns, but more importantly is, well, how do we minimize our lifetime tax bill? How do we give the IRS as little as possible, operating within the lifestyle that we're living? So all that said, standard deduction and itemized deductions. Every year we file our taxes, and you fall into one of two categories. You can take the standard deduction, or you can take an itemized deduction. Currently, the standard deduction for a married filing jointly couple is $30,000. So if you're going to itemize, you can itemize. You would never itemize unless your itemized deductions added up to more than $30,000. And the way these deductions work is, hypothetically, let's say you make $100,000. If you do nothing and you just take the standard deduction, when you go file your taxes, they take the first $30,000 off of that. So if you had $100,000 of taxable income, and then you take the standard deduction, now you're going to be taxed on the $70,000. So it's nice. It lowers your taxable income. You could lower it further, though, if you were to itemize, if that was your situation and if it made sense to do so. So again, when you itemize, it has to add up to more than the standard deduction, the $30,000. And when you itemize, it's a combination of certain things. State and local tax deduction, sometimes you hear the SALT tax, state and local taxes, mortgage interest, charitable contributions or donations, all of those things get added together. And if they all add up to more than $30,000 in most cases, you can itemize. And, let's say that they added up to $40,000. In that same example, you wouldn't want to take your standard deduction of 30. You'd want to take your itemized deduction of 40, which would lower your taxable income now to $60,000 instead of $70,000. So it saves on taxes. There are some restrictions, and even with the big, beautiful bill that just passed, it's constantly changing. For example, one that hits us hard in Texas, we don't have state income tax, but we do have high property taxes. So right now, or under the old law, the most you could write off each year was $10,000. Well, that's no big deal if your property taxes are $5,000. In fact, there's some strategies we can use there to try to double up on it in certain scenarios if it could make sense. However, if your property taxes are $20,000, you weren't allowed to deduct all of that. You could only deduct up to $10,000 of that. There's some rules we can, if you guys have questions on that, we can dig into some of the new rules around that. They're similar, but a little bit different. Same with mortgage interest. Yeah, whatever your mortgage interest is on your home, you can deduct that, as well as charitable contributions and donations. So I just wanted to kind of tee up the difference between a standard deduction and an itemized deduction. So what most people do is when they give to a 501c3 or a charitable contribution where you can get a deduction for it, most people go to work or go to their business, they earn money, they get a paycheck. The government withholds whatever percentage of, for withholding taxes that they withhold. And then you get whatever's left over. So, if you take home $5,000 a week, but $1,000 goes to taxes, you net $4,000 a week. In that scenario, you have $4,000 a week left over to do whatever you want with. You can pay your mortgage, you can pay your auto loan, you can buy groceries. You can also donate to any charities that you support. That's what the average person does. And when they do that, what they're doing is they're giving a dollar that has been fully taxed at whatever their current tax bracket is. That's not bad. The charity is very happy to receive your money. But in many cases, there's a more efficient way you can do it. And as the numbers get bigger, the savings becomes bigger. One thing is, and we're going to show a couple examples of this, but often you can give an appreciated asset. So if you have artwork, or if you have a business, or if you have Apple stock or Tesla stock or whatever, an individual stock or bond or mutual fund or anything, if it's gone up in value, what you can do is, let's say, Jordan, is the next slide the one that we have the example of the appreciated stock? So in this example, you have a scenario on the left where you're giving $50,000. And you have a scenario on the right where you're giving $50,000. On the left, you're giving $50,000 of money that's already been taxed to you. So if it was, in your checking account, you've been taxed on it, at 25%, well, the money that's left over after a 25% tax would be $37,500. In that scenario, $12,500 goes to the IRS. Well, let's say you had Apple stock, and let's say you bought it. Let's say you bought it for $10,000 and then it grew to $50,000. Well, in that scenario, what people do sometimes is they'll say, oh, I want to give to this building campaign at my church, or I want to give to Susie G. Komen or Wounded Warrior, or whatever charity of your choice is that you want to support. A lot of times people call and they say, hey, can I just sell some of my Apple stock and give some of that money to charity? And the answer is yes, you can do that. But that Apple stock, if you bought it for $10,000 and it's now worth $50,000, you have a $40,000 taxable gain in that scenario. So another option is you can take the stock, instead of selling it, you can just gift the stock to the charity. And there's different ways to do that. We're going to get into those in a moment. But when you do that, what you rob is you rob the IRS of the opportunity to tax those dollars, to tax those gains. So in that scenario, if you wanted to give $50,000 of Apple stock, the church or the charity actually receives 50,000, not 37.5. The IRS receives 0, not 12.5. So it's certainly a more tax efficient way to give. And you can give a number of different types of appreciated property or assets. So we're working with more and more business owners, and this is where it gets really fun and really exciting. If you have a charitably inclined business owner, this scenario is, you start a business, sweat equity, you're working hard, maybe you own it for 20 years, let's say, and over the course of time, you end up adding, 500,000 of your own money into this business. That's called your cost basis. And let's say that 20 years later, you sell the business. One thing that's true for every business owner is one day you will no longer be the business owner. Either you're going to decide to sell it, or you're going to pass away, or something's going to happen, and one day you will no longer own the business. So it's good to have a plan in place on what your exit strategy is. Similar to that Apple stock, oftentimes, if you go to market and you sell your business for $10 million, well, the IRS says, okay, well, you had 500,000 of your own dollars into it. So in this example, you made 9.5 million on the sale of your business. We're going to tax that. And then everything that's left is what you have access to give or to live off of, or whatever your goals might be. Now, again, if you're charitably inclined, in this scenario, we said, well, what if you gave 20%? And we're just making numbers up here, but if you gave 20%, you could give, again, an appreciated asset, just like the Apple stock. Now you're just giving a part of the business prior to selling the business, and you get to put it in a charitable fund. And kind of the same scenario, it's just bigger numbers. You end up getting taxed on less. The IRS gets less, the charity gets more. So in this example, if you're the business owner, you could sell the business and then give out of what's left. If you gave 20%, you can kind of see the charity in that example would get about $1.6 million. They're not going to get $2 million. If you gave prior to selling the business, the charity would get the $2 million. The difference, there's a big difference in the taxes there. In the first scenario, you sell it, and the capital gains on that, it's going to be capital gains on 1.9 million versus 1.5. And the charitable deduction that you just get a larger charitable deduction for your giving. Obviously, that's equal to the gift amount. So the tax savings, in this scenario, it's a little over $140,000, while the charity getting almost $400,000 more. So it's a win-win for everybody except the IRS. And we love scenarios like this. So one way that, whether it's Apple stock or whether it's a business interest or any other asset, one thing that we use often is called a donor advised fund. And I kind of describe it sometimes, it's like online banking for charity. So you could put $50,000 worth of Apple stock, or you could put 10 million or $2 million worth of business interests, or $5,000 worth of, some other position. You could do essentially almost any amount you wanted to. But when you put money into a donor advised fund, you get the credit, you get the deduction in the year that you put the money into the fund. You are giving money to a charitable organization, or it's earmarked for a charitable organization, and in that year you get the tax credit. So if you were a business owner and you were going to sell, and let's say that previous example, that you sold it for 10 million and you wanted to give $2 million to an organization, well, maybe you didn't want to give $2 million all at once. Maybe you want to give 200,000 for 10 years, or 100,000 for 20 years, or whatever the scenario may be. But in a year where you're selling a business for $10 million, you're going to be taxed at a very high tax rate. So you want the largest deduction to try to offset that as you can get. So in a scenario like that, if you lump all of your giving, for the foreseeable future into 1 year and fund this donor advised fund, you put the money in the donor advised fund again, then you get the $2 million deduction, or the $50,000 deduction, or whatever the dollar amount is. You get the deduction in that year. Once the fund is in that, your assets are in this donor advised fund, you no longer own those assets, but you absolutely do control those assets. You can say, what charity do they go to? How much does a charity get? And when do they get it? And it doesn't even have to be in your lifetime. You could say, maybe you give half the account and then, leave it for the kids to give the other half. There's a lot of ways to structure these, but it's basically, you can go on and you can set a payee and you can say, hey, I want this charity to receive, a lot of people use their church and they say, hey, I want to give, $1,000 a month to my church. Or maybe there's a building campaign and maybe they give an extra 10 or 20,000, or, there's any number of different scenarios. But again, what the donor advised fund is you're taking an asset that's gone up in value, you donate it, so it goes into this account, kind of that piggy bank. It's, and it's just there. You can invest the money when it's there. You can leave it liquid. There's a lot of options once it's in that donor advised fund. You control it fully. You just can't take it back out and go buy a car or anything like that. Again, anytime you put money into the donor advised fund, that year you get the full deduction, current day tax deduction for that. And then you can just give it any future date, any amount to any organization that's a 501c3 organization. Jordan, you want to take this, or you want me to take it?
Yeah, sure. Yeah. So bunching donations simply is a play off of what Brian was sharing earlier when we compared a standard deduction to an itemized deduction. Remember, if we're continuing to use an example for a married couple, we have to exceed that $30,000 threshold in order to take an itemized deduction. So here I have an example of what someone would be donating on a regular basis. Let's say in 2025, 2026, and 2027, you're planning on just donating $20,000 to your church. Now, this would fall below your itemized deduction, so you'd still be taking the standard deduction, and you'd still be donating $20,000. And I think Brian would agree, we're not here in just for the benefit for ourselves, but if we have the ability to do things in the most tax efficient way possible, we want to do them, right? So what bunching your donations is, it essentially takes these three, for this example here, you take these 3 years and you combine them into one. And for this example, I have 2025, right? We combine this all into one as in $60,000, we're going to give this in 2025. Now, what I've done is I've helped boost my deductions by exceeding that standard limit in 2025. And then in years 2026 and 2027, I'm still going to give that $20,000, only I'm going to take the standard deduction in those 2 years. Now, you can go back and forth, right? The IRS doesn't care. You can take itemized deduction 1 year, you can take standard deduction next year, and you can keep flip-flopping as much as you'd like. There is no limit on when you can switch and vice versa. And then finally, kind of playing even further off of that, there's also qualified charitable distributions, right? And this is going to be similar to everything that we've described. And frankly, this is one of my favorites because not only does this have the same benefit of everything we've been sharing with you, this is also going to have the potential to satisfy your required minimum distribution, right? Your RMD for short. So let me give you an example here. And if you guys have any questions on anything we've covered, feel free to enter them into the chat box. But let's say that you have rolled over your 401k to a traditional IRA, and you regularly give $30,000 to a church or to a charity. But this time, once you turn, you have to be 70 and a half years old. Once you turn, we'll say 73 when you're taking your RMD. Instead, you do that $30,000 directly from your IRA to your church. And the key word there is directly, right? As I have a note at the bottom there that says it must be given directly to it. You cannot serve as the middleman. Well, essentially what I've just done now is I've satisfied my RMD. For this case, we're going to assume that it was $25,000, and I'm still able to have all of the benefits that I mentioned before. You nor the charity pays taxes on this transfer. So a qualified charitable distribution is essentially a superpower if you are someone that donates in retirement, and it's able to take advantage of all those things and satisfy your RMD in the meantime. This is the last slide, and before I turn it back over to you, Brian, the last thing we always mention is we never let the tail wag the dog whenever we talk about donating. right? You never want to do something simply for the benefit of tax savings, right? Because at the end of the day, yes, you do have to part with this money. As Brian mentioned, if it's a donor advised fund, once the money goes into the fund, you do receive a present day deduction, but that money is irrevocable from here on out, right? It's essentially property of someone else. In the same way, you don't want to pull out a credit card, or you don't want to do something just for the tax benefit or for the reward of doing so. Now, we're both big believers in the fulfillment that donating and giving back does to the community, to churches, and so forth. So we know a lot of our clients are that way as well. So just being able to do so in a tax efficient way is very empowering. And I'll let you close out, Brian.
Yeah, thank you. That's great. Real quick on this QCD, just to drive home one more point, those mandatory distributions that you take from your IRA in the future, those are all taxable to you. So what this avoids is, in this scenario, if you were to give 30,000, well, that's 30,000. What a lot of people do, and we see this all the time, is they get their RMDs, they have it sent to their bank account, they get taxed on it at whatever their current tax bracket is, and then they give out of their bank account whatever's left over, and that and so they're being taxed on the money. Same thing we've said kind of over and over a few times, but this going directly, it just avoids taxation, and it gives it directly to the church or charity, and it's a great way to go. That's all we had for you. So there's a lot here, and we are trying to do our best to keep these within 30 minutes. We appreciate everybody who can join. These are going to be on our YouTube channel as well. If you ever have additional questions or want to dig in deeper to your specific situation, please reach out anytime. This is something we're very passionate about. And then the other thing is, if you have topics or ideas, we're trying to do these, once or twice a month. We're still trying to work out the exact cadence there. But if there's topics on, different things that you'd like us to dig into deeper, briefly, we'd love to hear your ideas and, as always, your feedback. So thank you. We're so blessed to be able to work with you. We love what we do. And I hope this was beneficial, but I hope you have a great rest of your day.
Thanks, guys. Take care.